What if I told you that nearly half of all US homeowners don't own a dime on their property? And that is reshaping the real estate market as we know it and hanging up the price drops that we are expecting from the other macroeconomic trends we're experiencing in the country and in the real estate market right now. That's what's going on. And on today's episode of the Informed Home Buyer Podcast, we're going to get into it. We're going to break it down for you, what this means for you as a buyer. Is this likely to continue? And should you be thinking about paying off your home? Is this a good goal to reach for? In our opinion, stick around to the end for that. As always, I'm your host, Rich Curtis, and I have with me my co-host, Dave Miller. How you doing, Dave?
I'm good, Rich. Thanks for having me.
All right, so here we go. Shocking article, and to be honest with you guys, Dave and I, we always talk offline, of course, before we hit the big red record button there. And this one really shocked us, Dave. I mean, would you have expected before we read that article that 40%? So I said at the opening, nearly half. The statistic is actually 40% of U.S. homeowners have no mortgage at all, have full equity in their homes. That one blew me away.
Yeah, and I've been doing this a long time, and over the years, the last 20 plus years, a big part of my business has been refinance business. And most folks that come to me to refinance, I just had one a month ago that their house was paid off, and they pulled out a small $100,000 deal to pay off debt. But for the most part, when folks are coming to me, they're adding to their debt, or they're lowering their interest rate and keeping their debt the same. But rarely, and like I said, I've done, people that bought their house 15, 20. Most of these folks haven't paid off their house yet. So I don't know where all these people are that don't have a mortgage. But with these short, low interest rates that they had, we're not talking our parents' generation. We're talking our generation that, they've been doubling up on payments and taking advantage of a lot of money going towards principal with low interest rates. So, they're knocking out their mortgages quicker than people used to.
Yeah, and I think life expectancy is playing a role here too, right? When the life expectancy in the country was 60 or 70, and you got 30-year mortgage horizons, less people are paying off. But the amount of people living into their 80s and 90s now, so we've got boomers hitting payoff milestones just from longevity at this point, right? Just from
Yes.
good health.
Yes.
And then we have, maybe millennials, older millennials, they're
Yeah.
reaching these payoff milestones
Yeah.
just because they got those low interest rates and they are making those double payments like you're talking about.
Yeah. And the other part of that, Rich, is when people, and I definitely have a fair amount of clients that have, when the rates really dropped, and maybe they had refinanced from a 30-year mortgage a few years earlier. A lot of these folks were doing a 10 and a 15-year mortgage. And so, we're getting at that point. Obviously, if you did it after the pandemic, you probably haven't paid off, but you have a really low mortgage balance. But a lot of folks that, took advantage of the low interest rates in, the 2016, 17, 18, that had a 10 or 15-year mortgage and have made extra payments, they're now debt mortgage free.
Yeah. And that during the pandemic, with the pandemic era interest rates, the interest rate on a 15-year mortgage was, I mean, bananas. I don't know how anybody's even making money from a loan perspective on those. Like, what were you getting a 15-year mortgage rate for in 2021?
Well, so that's the thing, is that the spread wasn't that much different. So go back 10 years, 15 years, but pre-pandemic, I would say like 2000, after the Great Recession, the spread was much larger between a
Ah,
30-year and a 15-year mortgage, but the spread wasn't that much different. But I mean, it's all relative, right? If you have if it was 33% lower for a 15-year mortgage, if you had a 3% 30-year rate and you have a 2%, that seems like a lot, right? But when you had a
yeah.
6% mortgage back in the day, when we were averaging 6%, a 15-year was around 4%. That was a 2-point delta. Um, and it made a big difference in interest rate, but the payment was still more expensive, or quite a bit more expensive. But that time horizon to pay it off, people were really enticed when they saw that 2% delta. And now when I have people ask, should I do a 15-year versus a 30? Especially over the last, 4 or 5 years, it's always been do a 30, make the extra payments, put the money in an interest bearing account. You could pay down your mortgage whenever you want, or extra principal. But I don't recommend doing the 15-year and being locked in. So I think maybe a lot of people did that as well, right? Like, you're used to making this large payment. You refinanced your interest rate from 5% to 2.75, and we're either doubling up payments or saving that money and then writing big checks and getting your mortgage paid off.
Yeah, and I think too, there's been some cultural movements, right? Like Dave Ramsey got huge, and he just pounded the drum of pay off your
Mhm.
mortgage. You will get to this later. I actually disagree with him on that. You were kind of mentioned just now. You disagree with him on that too.
Yeah.
The fire movement, the sort of financial independence, retire early movement. A big chunk of that movement is pay off the house so you can just pummel all of your savings into the markets and build up a big enough nest egg to retire early. And with no mortgage, your monthly nut is lower, which means you need lower in your brokerage account to do your 4% drawdown and retire when you're 30 and all this business. So there's been some cultural movements that have contributed to this. But
Yeah.
the outcome of this is another data point in this really interesting market. I was talking about in a video I just shot. So actually, probably as you're watching this, guys, this video will be out before the one I'm referencing right now. But I was just talking about how the market right now, it's kind of in fibrillation, to use a medical term. Like when someone has a heart attack, their heart's not in a good rhythm, like normal rhythm. It's not in a bad rhythm like AFib. It's tweaking out. It's just twitching and doing nothing, right? And they get out the paddles and they try to shock that bad boy back into something reasonable to work with. That's kind of what's happening in the market. We have all these macroeconomic trends that should be just causing pretty fast and pretty significant price decreases in real estate. Then we have these other factors coming in, like high equity from all the equity people gained during the pandemic, low interest rates from the low pandemic era interest rates and lock-in effect. And like the delisting trend we talked about in our last podcast. If you haven't watched that one, go back to last week's. I think the thumbnail says something like sellers giving up minus 50%. That's what it says in the thumbnail. Watch that one. It's good. That delisting trend with delistings being up 50%. And then add this one into the bucket. You have people who've paid off their homes and they don't want to go anywhere. They don't have any mortgage payment, right? And the prices are so high, if they were to sell, they might have to take on a mortgage payment and take on a mortgage payment at 6 or 7%. That is something you don't want to do if you've already paid off your home. You want to stick and stay and enjoy the benefits of that. So where
Yeah.
we have these macroeconomic trends that might be pushing prices down, we have these competing forces that are fighting for balance in the market, like this one, that are saying, sure, there's downward price pressure, but we still have really low inventories. That's the rub of 30 million people, or 40% of homeowners not having a mortgage, is most of them are going to choose not to sell, and that keeps our inventory low.
Yeah, and I think part of that delisting, like you just referenced, Rich, is a lot of those people like, yeah, maybe we'll test the market, put our house on the market. If it sells and we get a great price, maybe we'll do something different. But the motivation level is not where it needs to be, for someone to sell their home. What's the sense of urgency? There's just not, right? There's
Yeah.
I'll put it out there, see, in a short amount of time. Like selling a home is not fun. We talked about that, I think, even on the last one. You don't want to make your house available for 6 months for people to come walk through, take a peek, and keep it clean and do all things you need to do. It's just not worth it for some people. So they just delist it, move on.
Yeah. And so if we were going to see the type of big price drops that, like there's a fear, uncertainty, and doubt driving the market. There's the craziness in the stock market, the tariffs, the trade war, all of that business. There's all of the federal people who have lost their jobs. And then there's all the other job loss that's tangential to the tariff business. There's all the job loss in the healthcare sector now, because the recent bill that was passed with the Medicaid cuts is affecting rural hospitals. Some have already closed. So there's a lot of job loss in the medical field right now. All of that is stuff that, causes buyers to pull back, causes a contraction in the buyer pool, which should increase inventories and bring prices down. But at the same time, you have sellers who are saying, give me my price or I take the property off the market because I can, because I owe
Yeah.
nothing, or I owe very little, or I have a 2% interest rate. And so there's this push pull between a market that desperately needs price reductions to increase affordability and bring buyers to the table, and a market where people don't
Yeah.
really have to sell.
Correct. And if you have kids that maybe are moving back in with mom and dad, especially up in your area, Rich, I know very popular right now is building an ADU. Why am I
Yeah.
going to sell my house? I got a little bit of land. ADU is one of the fastest growing, real estate trends right now across the country. But I
Yep.
know even in the Bay Area, especially up in, the El Dorado County areas of Sacramento County, if there's space, people are putting an ADU, whether it's for your kids or for additional income, rental income. Why go buy another house? So if you could swing that payment and get that ADU built for a reasonable price, makes sense for a lot of folks.
Yeah, and if you own your home outright, then the cost of putting in that ADU is nothing,
Right.
compared to selling that home, losing having to go get a mortgage on a two house on one lot property that are more expensive. It just doesn't make sense. In
Right.
fact, a couple of years ago, the governor pushed through some legislation to make it pretty much counties, municipalities can't block you building an ADU. If you have enough land to build an ADU, you get to build an ADU, which is it's rare in California that we say they passed a law that made something easier, but they in this case with that ADU trend, they passed a law that made something easier, and then that kind of caught off like wow, there's all these ADU companies now coming to the
Mhm.
table, and so we are seeing a multi-generational living making a comeback in that way. And that also is keeping our overall inventory low because oftentimes with my generation, they call the sandwich generation. We have kids going to college and parents dying at the same time. And so when that happens, you look to multi-generational living to try to bring the costs in, get the parents living on the property with you while the kids are at college, yada, yada. That usually requires a sale and a purchase. And that's usually a purchasing up to a more expensive property. And so we move two units in the marketplace. We move two loans in the marketplace. Money moves around. The real estate market chugs along. And we're not seeing that because multi-generational living is now being achieved through a different way through that ADU trend. So it's
Yeah.
a really important point. All of this, guys, is to say that if you're a buyer right now, approaching the market with a wait and see because I need it to come down to become more affordable, we're not saying that's a bad idea. That might be a really good idea for you in your economic situation. We're saying that right now, our reading of the tea leaves doesn't show massive price drops in 2025. I believe, and Dave, give me your take. I believe we are going to see price drops continue. I think we are going to
Yes.
see prices continue to trend down. I just don't see them being huge drops because these other competing forces like this.
No, we are going to gradually come down and it'll be a supply and demand issue. So unless there's a gluttony of supply, prices aren't going to, right? They're just not going to drop. So everything
Yeah.
that you just explained alluded to until overabundance of supply, we're just not going to see, even though supply levels, and we've talked about that, are increasing to more normal markets. Um, and I've always kind of talked about, I've been doing this a long time in the business. When homes are going up really fast, we're really busy. And when they're coming down really fast in value, we become pretty busy. Um,
Yeah. Yeah. Right.
not- you
When
know, uh,
everything's tweaking out in the middle, there's not a lot going
yes.
on. Yeah.
Yeah, exactly. So that's a great analogy. It's just kind of sitting there in
Yeah.
the middle tweaking. And so, if like you said, those two properties aren't moving because the people that would have went and bought another house for multi-generation living are just building that ADU. Well, the house that they just vacated that was too small for their multi-generational family, they're just staying there and they're just adding more square footage to it. And so those are just, just less units that are on the market for folks.
Yeah, and I think that's the big takeaway here when you're watching the news right now. We did another episode a few weeks ago on Yahoo saying the market's falling before our eyes, everything's crashed. There's all this salacious end of the world business going on in the news, and we want to try to help you kind of pick out the signal from the noise. And what the news isn't taking into consideration are all these sort of unprecedented factors going on in home ownership and in the market at the moment. So if you just look at the macroeconomic trends and you just base it on what's always happened in the past, you'd be like, prices are dropping like crazy. But that's totally different. In the Great Recession in 2008, 2009, a homeowner was sitting there. They had bought their house with zero money out of their pocket. They had zero money into the house. They were making payments that were either not chipping away at their debt or going negative AM every month. So they're owing more month after month. So when they lost a job or needed to move or just felt like they were underwater on their house and making a big mortgage payment, the decision making matrix was totally different. I didn't put any money in this damn thing. I don't have any money tied up in it. I have a 5 or 6% interest rate, and I'm not going to be positive on this house for 15 years. I'm just going to put the keys on the counter and walk away. We had some massive waves of foreclosure, but a lot of them were strategic rather than necessary.
Yeah,
We're
100%. Well,
now,
yeah,
what's
go
up?
ahead.
No, go,
Uh,
go, Dave.
I was just saying that, like, when we talk about, and we're predicting values maybe to come down very gradually or a little bit, but I think the misconception is for the last 5 years we've been going up like a rocket in value. Now, all of a
Yep.
sudden, if you have a house to sell and you put it on the market and you didn't get an offer in 7 days or 30 days, you think, oh, this market sucks for sellers. No, it's just a
Right.
normal, it's moving towards a normal market. It doesn't suck for sellers. It's just, it's not like it was the anomaly that we had for the last, previous 4 years. It's just not reality for things to sustain that way. And I quite honestly am rooting for values to hold steady or come down a bit, just to open it up for the younger generation that do want to go get their own home and live the American dream and make this affordable. So if rates come down too fast, we're going to see a gluttony of buyers come out of the market, right? And it's going to drive up values again. So if rates continue to just slightly come down at a normal pace and values come down at a normal pace, we're going to get to that equilibrium where people can buy and sell. And hope, but we do need inventory levels to pick up for that to happen.
Yeah, and I think it's just not gonna happen as fast as those buyers who've been frozen out of the market want it to, and certainly not as
Right.
fast as the nightly mainstream media news is telling you it's going to. So, because you made a couple of really great points there that I want to highlight. So one, yeah, people before when all that defaulting was happening, people had no skin in the game. Now the difference that these news outlets aren't taking into account is unprecedented levels of equity lock in effect from 2 to 3% mortgages, nearly half of all homeowners having paid off their home outright, a trend towards multi generational living. All these things are keeping the inventory low. Now, the buyer pool is also, though, even as the inventory is low, but it is increasing. We are up 40 to 70%. So 40% average nationwide increase in inventory, 60 to 70% in some of our local markets. Sacramento's up a little over 60%. Placerville was up 69% last month, year over year in terms of inventory. So inventories are rising. However, the buyer pool is contracting at the same time, right? And so we've got all these push pull factors. And one of the sad statistics that Dave and I were just talking about is, over the last, I think it was like 20, 24 years, we have gone from new first time home buyers in the 3 to 3.1 million range down to just a little over a million in 2024 new first time buyers. So 1/3 of the amount of new first time buyers now, and it is the lowest level of first time buyers in recorded history, about 40 years, not recorded history, I guess, since we've been tracking it as a safer way to say that. In the 40 years that the National Association of Realtors has been tracking these numbers, this is the lowest amount of first time buyers we've ever had. And so affordability is obviously at an all-time low. So it might sound strange for realtors to be pulling for price reductions and lenders to be pulling for price reductions. And certainly Dave and I own homes too. In fact, more than one home. And so prices dropping isn't good for us. It doesn't feel good for us to see our prices come down. But if I have to take a $50,000 equity haircut along with the rest of America so that we can increase the number of people who can buy a home by 1%, 2%. We had 1 or 2% of people who can participate in the American dream who have been frozen out of it for decades. Now, you can make your own decision about that. I'm willing to take that haircut to see more people be able to participate in the American dream than less. That's good. It's good personally, self-serving wise for us as realtors, more transactions, right? But it's good for all of you. People buy a house, they also go out and they buy sod for the backyard and gravel for the front yard, and they buy couches and washing machines and paint and all of that sort of things. They feel more secure, and if they're young people, they start to think about having a family, and they have babies, and boy, I can tell you I have two of those, and that costs a lot of money. These things move money throughout the country. This is the backbone of America. This is what keeps us all stable, safe, and having a strong economy. So I'm personally willing to take a little equity haircut if we can bring more people into the fold and have more people participate in the American dream, not only for sort of a patriotic, altruistic reason, but just for a purely financial reason. That moves a lot of money around the country and is better for all of us. So if you couldn't give two shakes about how many people get to buy a house, you got yours and you don't care who gets theirs, fine. It's still better for you to have a lot of money moving around the economy. And that's what affordability does. And so it's not going to be as quick or as much as we'd like, but we are seeing some price declines. And I hate to hope for this, but I do in some ways hope for more.
Yeah, and I think part of that, Rich, and what kept us busy back in the day, and hopefully we see that as values become to come down, interest rates come down a little bit, but rents hold steady, right? There's still a shortage of supply, so rents are holding steady. If they don't come down, parallel to values and mortgage payments, we're going to see a bigger increase in folks saying, because it's pretty easy to say, and back in the day, it was maybe, oh, $500 more a month to own versus rent. Now today, that's not realistic. Maybe $1,000 plus more to own versus rent. I'm getting, natural appreciation by paying down my mortgage, but we need that spread to be a reasonable, but no one or most folks aren't willing to double their monthly housing expense to be able to buy a home. And that's
No,
kind of
nor
where we're at.
should they, right? That wouldn't
No,
be
yeah,
a family or fiscally responsible thing. I don't want to see
yeah,
people do that. That's
right.
not good for any of us.
Yeah,
You
that's
know,
not that big of a dream to own a home, right? Right? Like,
Yeah, it becomes an albatross around your neck. You become house poor. That's not good for anybody. Yeah, the point
yeah,
isn't to increase home ownership by furthering people's
yeah,
economic hardship and indenturing people to their mortgages. The goal would be to increase home
yeah,
ownership through adding some sanity and reasonableness back to home prices and values.
yeah,
Uh,
yeah. And
so
I'm like you, I root for that. Like you, I definitely root for that. And that's just every more people win that way. So
yes, 100%. So I think, guys, we'll wrap it there. The point here is, as you're seeing the news tell you that the market should be dropping like a stone, and then you go back onto my website or MetroList or Realtor or Zillow, and you're looking at houses, and you're still can't afford one, or what you can get for the money still looks like it sucks, and you're wondering why there's this disconnect between the reality you're seeing on the ground and what the news is telling you. Well, that disconnect are all these other factors that are outside of the economic and real estate market norm, where those 2 to 3% interest rates really, really handcuffed us, really did a disservice to the real estate market. And we are seeing how hard it is to kind of break those chains. Artificially suppressing those interest rates for a time maybe helped right then, but we're really paying the piper for it now. And we're seeing that lock-in effect be stickier than we even thought it would be, because of all these other pieces that we couldn't have predicted coming together into the sort of gumbo that we have now, where the market is really fighting for balance. Now, it's going to continue to adjust, and there are lots of things in the offing that could change this. So we're going to come back to you week over week, keep explaining this, keep breaking it down for you, and show you what we see coming. But we wanted to come to you today and at least say, if the reality isn't living up to what the news is showing you, here's some of the reasons why. So, all right, folks, I think we'll wrap it there. Thank you, as always, for watching. Thanks for making it to the end with us. I've been Rich Curtis.
and I'm Dave Miller. Thanks, Rich.
See you all in the next one.